Most couples assume that if one passes away, the survivor stays financially secure. But a hidden IRS trap called the widow's penalty can instantly double your tax bill when you are most vulnerable. When you file taxes as a married couple, you enjoy massive tax brackets. You can earn up to $94,300 before even touching the higher 22% tax rate. But the moment a spouse passes away, your status changes to single. Overnight, that exact same tax bracket cuts exactly in half, down to just $47,150. What the government doesn't tell you is that while your tax protection drops by 50%, your living expenses stay exactly the same. The mortgage doesn't shrink, utility bills don't change, and the cost of maintaining your home remains identical. In fact, things like property taxes and homeowners insurance keep rising every single year. You are forced to carry the exact same financial burdens alone, but the IRS now treats you as a high-earning single individual. It gets significantly worse from here. Your standard deduction, which is the exact amount of money you can legally shield from the federal government completely tax-free, is also sliced right down the middle. As a married couple, you could safely protect nearly $30,000 from federal income taxes every year. As a widow, that crucial protective shield drops instantly to just $14,600. The IRS immediately begins taking a massive bite out of your retirement income from the very first dollar you withdraw. This is the absolute core of the retirement tax bomb that catches most American couples completely off guard. For decades, hardworking individuals focus solely on one single traditional goal: accumulating as much wealth as possible in tax-deferred accounts like traditional 401ks and IRAs. They blindly assume that their tax bracket will always naturally stay low during their golden years, completely ignoring how the system actually shifts over time. Unfortunately, they completely fail to mathematically simulate the devastating financial reality that happens when one of them is suddenly left entirely alone to face the IRS. The United States tax code is structurally biased against surviving spouses in a brutal way. The moment your partner passes away, your filing status changes from married filing jointly to single. This means you are instantly pushed into a significantly higher tax bracket, forced to pay much higher tax rates on the exact same amount of retirement income. The IRS essentially treats a single grieving person as a high-earning individual, turning an emotional family tragedy into an immediate, catastrophic financial crisis that can destroy a lifetime of diligent savings in a matter of months. Let's look at a concrete financial example. If a married couple enjoys a total retirement income of $80,000, they sit perfectly safe inside the lowest federal tax brackets. But if one spouse passes away and the survivor inherits that exact same $80,000 income from pensions and traditional accounts, everything changes. They are instantly pushed into the costly 22% and 24% tax rates. It is the exact same amount of money, but thousands of additional dollars now go directly to Washington. To make matters significantly worse, you cannot simply choose to stop withdrawing this money to save on your taxes. Once you reach the federally mandated age for required minimum distributions, the IRS legally forces you to take specific amounts of money out of your traditional retirement accounts every single year. When you are filing as a single individual, these forced distributions hit a much narrower, compressed tax bracket. This completely destroys your long-term financial planning, compounding the widow's penalty and artificially inflating your adjusted gross income. You are trapped because the law requires you to take the money out, and the law simultaneously punishes you for doing so. This artificial spike in your reported income quickly triggers a dangerous domino effect across your entire financial landscape, directly impacting your heavily earned government benefits and permanently altering your lifestyle. But shrunken tax brackets are only the first layer of this dangerous financial trap. The true structural damage happens when this artificial income spike triggers a devastating domino effect. In this next part of our roadmap, we will expose how it directly impacts your Social Security. Most people believe that Social Security is completely tax-free. That is a massive mathematical delusion. The IRS calculates your provisional income using a hidden formula, and for married couples, the threshold before taxes kick in sits at $32,000. But for a surviving spouse, that threshold instantly collapses to just $25,000. This microscopic limit means that up to 85% of your monthly Social Security check suddenly becomes fully taxable, forcing a grieving widow to pay taxes on money they already paid taxes on during their working years. What YouTube financial gurus never tell you is that this creates a toxic phenomenon known as the phantom marginal tax rate. Because every single dollar you withdraw from your traditional IRA or 401k now does double damage. It doesn't just trigger income tax on itself, it simultaneously forces more of your Social Security benefits into the taxable zone. In reality, this stealth tax mechanism means that a surviving spouse can easily find themselves trapped in a shocking, effective marginal tax rate of over 40% on their retirement distributions. You are essentially being penalized for trying to maintain the exact lifestyle you built with your partner, while the system silently drains your liquid cash reserves during the most vulnerable years of your life. The domino effect now moves directly into your healthcare. When you turn 65, your Medicare Part B and Part D premiums are determined by your income from 2 years prior. For a married couple, you can bring in up to $206,000 before facing any penalties. But for a single widow, that safe threshold is cut exactly in half, down to just $103,000. Cross that line by even one single dollar, and the government slaps you with mandatory monthly surcharges. What makes the Medicare IRMAA system completely brutal is that it is not a progressive tax. It is a strict cliff. If a married couple has an income of $105,000, they pay standard rates. But when that identical income transitions to a surviving spouse, they instantly breach the first threshold. This single dollar mistake forces the widow to pay thousands of dollars extra per year in completely unnecessary healthcare premiums. This money is automatically deducted directly from your monthly Social Security check before you even see it. It is a silent, aggressive drain on your liquid cash flow, operating entirely in the background, punishing you simply because you are now managing your retirement infrastructure alone. Fortunately, you do not have to sit passively and wait for this tax trap to spring. The single most powerful weapon to disarm the widow's penalty is a series of multi-year, strategic Roth conversions. By systematically shifting money from your traditional IRAs into a Roth account today, while both of you are still alive, you are paying taxes now at the lower, married joint rates. This completely eliminates any future tax liability for the surviving spouse, creating a permanent, tax-free shield. To execute this correctly, you must utilize a strategy called bracket topping. Each year, you convert just enough money to fill your current married tax bracket without accidentally pushing yourself into the next higher level. This allows you to lock in historically low tax rates. When the first spouse eventually passes away, the survivor will inherit a massive tax-free bucket of money. They can withdraw any amount they need for living expenses, healthcare, or home maintenance, and not a single penny of it will ever report as adjusted gross income. This single move completely bypasses the Social Security tax cliff, entirely avoids the Medicare IRMAA surcharges, and secures the surviving partner's lifestyle. You are taking control of your financial map, ensuring that the legacy you built together stays exactly where it belongs, in the hands of the person you love, and completely out of the reach of the federal government. Don't let the IRS tax bomb destroy your hard-earned retirement. Subscribe to our channel right now, download your tax roadmap below, and start protecting your family's financial future today.